Hello students, I am delighted to offer you a certificate course in fundamentals in banking and insurance which shall carry 2 credits. This course has been designed to give you a bird's eye view of the fundamentals in banking and insurance. These two sectors are fast evolving and the transformational change envisaged by them offers myriad job opportunities across the globe. Through this course, you will be trained on basic concepts of banking and insurance. As with many things in the contemporary world, banking and insurance also has undergone significant changes over the years. Banks are the backbone of all industries because every transaction where money is involved, the bank is the main character. Without banks, the whole economy of a country would come to a standstill. Banks attract savings from the people and encourage investment in industry, trade and commerce. Banks as such can be called the basis of economic progress of a country. Today, no country can progress industrially if it has no well-organized banking system. Recently in India, the banking habits of the people have grown to a considerable extent. The traditional commercial banking theory itself has changed in the light of developmental activities of the country. A bank is a financial institution which deals with deposits and advances and other related services. It receives money from those who want to save in the form of deposits and it lends money to those who need it as loans and advances. Banking is an evolutionary concept. There is a continuous expansion and diversification as regards the functions, services and activities of a bank. The business of banking is complex and multi-dimensional. A bank acts as a connecting link between borrowers and lenders of money. Its main activity should be to do business of banking, which should not be subsidiary to any other business. The concept of banking has undergone a dynamic change in keeping with the need to achieve rapid socio-economic progress. The development of the banking system marks a significant departure from the beaten track of traditional banking. The transition from seller's market to buyer's market has compelled the bankers to understanding the pulse and needs of the customers. Hence, today there is a combination of commercial and investment banking. Universal banks and retail banks marks a considerable shift reflecting a change in the consumption pattern of the people and thereby the banking habits. In the current global order, where the world has become a big village, consumers take a global look at the products and services in terms of price, quality, delivery and after-sale services. This trend has sown the seeds of competition in every sector of the economy and banking sector is no exception to this event. Growing integration of economies and the markets around the world have made global banking a reality. The surge in globalization of finance has also gained momentum with the technological advances which have effectively overcome the national borders in the financial services business. Widespread use of internet banking has widened the frontiers of global banking and it is now possible to market financial products and services on a global basis. In the second week, we will be studying deposit accounts, where the study of the relationship between banker and customer is possible only if we have a clear knowledge of the meaning of the two terms. But unfortunately, both the terms have not been defined satisfactorily either by the judiciary or by any authority on banking. The primary relationship which flows from the essential functions of a bank is of debtor, creditor or vice versa with its customers. But depending on other functions being performed by banks, several other relationships also exist which may be in the form of general relationship or special relationship. One of the major functions of commercial banks is to mobilize the resources of the country and utilize them to achieve productive and socially desirable goals with the objective of achieving economic growth with stability. The attainment of this objective of economic policy depends on the adequate mobilization of deposits. Commercial banks accept various types of deposits, and while doing so, they have to take adequate precautions in the opening and operation of such deposit accounts. Moving on to the third week, we will be examining lending principles and negotiable instruments. A bank operating with high liquidity may have a low solvency risk, but with a trade-off of low profitability. Conversely, a bank operating at a low liquidity level may face high insolvency risk, but with a trade-off of higher profitability. Higher liquidity is often costly to banks, indicating that high liquidity reduces profitability. Hence, liquidity management forms a critical component of bank policy. The problem for a banker is to decide the proportion in which his fund should be divided between liquid assets and more profitable assets. Currency is an important means of payment in India. It is supplemented by checks and drafts for payments in commercial transactions. Various other paper instruments like a banker's check, payment order, money order, interest or dividend warrant, refund orders, gift checks, postal orders, bills of exchange or hundi, bearer bonds, some types of promissory notes are also used to cater to the specific payment needs. The statutory basis for these instruments has been provided by the Negotiable Instruments Act 1881. It was enacted to define and amend the law relating to promissory notes, bills of exchange and checks. The Act has been amended from time to time. Negotiable instruments have great significance in the modern business world. These instruments have gained prominence as the principal instruments for making payment and discharging business obligations. In week 4, we will deal with technology in banks. The change in banking in the last decade is unparalleled when compared to the entire period of banking history in India. Profitability, which remained a taboo for bankers for years since independence, has become a buzzword today. Thus, competition fueled by technology drives banking today. Banks have introduced modern technology in a large way in their day-to-day operations. Technology in banks refers to total branch automation, which has now given way to a core banking system. Core banking is a centralized branch computerization model in which branches are connected to a central host. It includes branch automation models and online multiple delivery channels like ATM, debit card, telebanking, internet banking under one roof. The banks in India are using information technology IT not only to improve their own internal process, but also to increase the facilities and services to their customers. Efficient use of technology has facilitated accurate and timely management of the increased transaction volume of banks that comes with a large customer base. One of the visible outcomes of this is that banks are aiming to serve the hitherto unbanked population of the country at their doorstep. Next, in week 5, we move on to insurance business, one of the prominent areas of financial services during recent times. It performs remarkable feats by insuring the insurable public and its properties in metro cities, big towns, and even in most inaccessible rural areas. In view of its crucial significance, the insurance business, life and non-life insurance, has been comprehensively networked in almost all parts of the country. The nature of insurance industry is different as compared to manufacturing and service industries. The fundamental difference between insurance products and other products is that while in the insurance products, consumers' interests are actively involved even after the sale of the products, since their liabilities have to be met by the insurer. No such consumers' interests are involved in other products. Finally, in week 6, we will examine insurance in the contemporary context. The relationship between capital formation and insurance services in both developed and developing economies of the world is prominent and noteworthy. The role of actuary in insurance industry is growing to a large extent. Actuaries help in designing insurance plans and evaluate the financial risk of the company while selling an insurance policy. Until recently, insurance services in India were provided by the public sector. The insurance industry was opened up to the private sector in August 2000. The primary objective of liberalization in the insurance sector was to deepen insurance penetration by enlarging consumer choices through product innovation. The increased competition has led to rapid product innovations for catering to the diverse requirements of the various segments of the population. Students, with this we now come to the end of the overview on the course in Fundamentals of Banking and Insurance. I look forward to having you on the journey of learning the fundamentals in banking and insurance, and let us make it a fruitful one. Thank you.